All right, thank you for everybody's patience. We're going to go ahead and get the presentation started now. Hello, everyone, and thank you for joining us today for our presentation, Why Diversify with Multifamily Real Estate Investing with Jerry Goodrow. My name is William Mucker. I'm a client executive with Camaplan, and before we get started, I have a brief note and a disclosure statement to go through, and then I'll pass it over for Jerry for his presentation. That note would be that Jerry is going to be taking questions at the end of the presentation. If you look at your screen, there will be two options, chat and Q&A, or question and answers. If you could pose the questions in the Q&A section, you can pose them whenever they come up to you, and they'll be saved for the end of the presentation for Jerry to answer. And then without any more hesitation, we'll go in and start the disclosure. This basically is just letting you know at Camaplan, we're a neutral third-party administrator of IRAs. We don't give any advice, and we're not tax professionals, we're not legal advisors, we're not financial advisors. So if you need any advice in any of those fields, consult with your necessary team of professionals. And if you would like to bring them into Camaplan and we can discuss it together, feel free to do that. We also do not endorse any product or give any advice in any of those fields. So please do your own due diligence whenever it involves investing your personal money or your retirement money or anything like that. Here is my contact information. If you or any like-minded individuals that you know would like more information about this webinar and how it applies to you and how you can use your retirement funds to benefit from it, please feel free to give them my information or call me, email me, and I'll be happy to answer any of your questions as it applies to self-directed IRAs. And without further ado, I'm going to stop sharing my screen and pass it over to Jerry, and he'll introduce himself and give you the presentation you all came here for. So thank you.
Thanks, Will. I appreciate the intro. And can everybody see me okay? Can everybody see my screen all right?
I can see your screen, Jerry. Your presentation is not up yet.
Well, it's up here. Let me do this one more time. I might have done it a little bit too quick, Will. So goes.
There you go. Perfect.
Up there now. So
yes,
anyway,
sir. You're all set.
Thanks for the intros. I appreciate it. Appreciate everybody attending on a midweek hump day, as everybody call it, for during the lunch hour. So I appreciate everybody attending this webinar. Hopefully I'll try to make it as educational as I can. And I do want to mention that Camaplan has been a good partner of ours. The CEO of the company is actually invested with or has some of his IRA funds within Camaplan, and he thoroughly enjoys working with them and their professionalism. So I highly encourage, if anybody's not set up with them, to give them a call, and they'll definitely help you out on that side of it. So the main purpose of this is we're just going to talk about why diversify in real estate, specifically, multifamily, and how that applies and where the market is heading. So I'm trying to, the goal of this is just to give everyone kind of an idea where multifamily stands, why the marketplace is still really good. Everybody has seen home prices just explode over the last 12 months or 24 months. And that is still occurring in the rental market as home prices become out of reach for, especially for the younger generation. Their tendency is to head towards the rental market. And I think you'll see that trend will continue, at least for the foreseeable future, until housing stabilizes a little bit and becomes a little bit more affordable. So we think the rental market, specifically apartments, are still a good asset class to invest in, and still a good long-term, safe investment for somebody that's looking to invest money into. With that, I just want to talk about a little bit about us. One of the things that I get asked a lot of time from my investors are, what is our experience and what is our qualification as it pertains to, real estate? One of the things that James Management Group, I think we're pretty proud of, is that we only do apartments. We don't do single family homes. We don't do warehouses. We don't do other types of asset classes. We just do apartments. And as of today, we're just in the state of Indiana, and we'll probably be expanding outside the state, but typically to markets close by, because we also own our property management company. So having our property management company as part of our corporate gives us a kind of a heads up as far as being able to maintain the property, take care of our tenants, and kind of move down that path. One of the things that we look for is from an acquisition standpoint, renovation standpoint, property management. So we look for the right asset class to buy, and we'll kind of talk about that a little bit later. We look at properties that we could potentially renovate, although we do have some brand new properties that we have in our portfolio now, and it has different dynamics and different returns, and it's more of a longer term hold, but it still generates good cash flow. We focus on ABC type properties. Value add is a good strength of ours. In fact, in 2021, I think we did $6 to $8 million of rehab work on our apartments. So we know that market really well. So one of the things that, as we go through this a little bit, if you have questions that come up, put them in the Q&A and we can kind of talk about them after we get done. But some of the things that I get asked is, why James Management Group? Why multifamily? What is our expertise that gives us the ability to provide value to our investors? And so you kind of go through, why we're good at sponsor. And again, what I said before, we focus on that marketplace. So some of the things that if you're looking to invest in multifamily, try to find a sponsor that knows what he's doing, that's been in the business for a long time. James Management Group started in 2005 and officially became James Management Group in 2011. And the whole time we've been in the state of Indiana. So we know this market really well, and I think we're pretty good at it. The other thing that we do is when we talk about finding the right asset in the right location. So some of that is, going through and making sure that the property fits what we're looking for. Is it in a location that's undervalued? Is it in a location that's been poorly managed? Can we do the right renovation to that property to create value and create value for our investors? And if we can answer all those questions and buy it at the right price, then it's typically a good investment. So with looking, and everybody does these things a little bit differently, but when you look at how we go about from a due diligence standpoint, as you can see for the first bullet point, location, 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 and I want to kind of preface that a little bit. You can go and buy a property in our example, downtown Indianapolis, and you may have to buy it at a 4 cap, and you may be paying $250,000 a unit. It may be worth it, but we personally think that's a little risky. Because if you have any downturn in the market and your tenants kind of, especially occupancy starts dropping a little bit, those rents and mortgage payments are going to be very, very hard to hit. We personally prefer more of the peripheral type locations, tertiary markets, some of the larger cities within the state of Indiana, Lafayette, Fort Wayne, Evansville, Muncie. Most of these locations typically have a pretty good college atmosphere, and they have a good growth rate over the last 10 years. It's some of the reasons we're attracted to those markets. And we can also buy them at a kind of a reduction off of what you would find in Indianapolis. The other thing is a diverse, I put this on here for a reason. So diverse employment base. One of the things you want to be very careful of when you're looking for an apartment complex in a location with a sponsor is there one really big employer in that market that employs 10,000 employees, and in a year or two from now they close that location? It could be devastating to your profits on a particular property. So you want to be very careful. You want to go look at a location that has multiple companies and a diverse, like medical. You want to find manufacturing. It doesn't really matter as long as you have enough diversification within that market, and the market is growing is always a good thing to look for. Projected property or population expansion is the second thing that we look for. So we look for areas that have grown or are growing, especially over the last 2 or 3 years, that's usually a good sign that market's going to continue to stay healthy. Rent growth is always critical, but typically if you have lack of new development going into a market, typically rents are going to continue to grow because there's no rental to be had as far as from a new property. So anything that's existing will continue to grow in value. And with the high cost of entering a market with new construction today, we think the rental market on existing assets is just going to continue to rise. And this is across the United States. It doesn't really not just apply here to Indiana. And people have heard stories in, Florida and Texas where, rents have gone up 15 and 20% over the last 12 months. We typically don't see that in Indiana, but my rents also don't start at $3,000. My rents are a little bit more reasonable than that and a little bit more cost effective. And I think that's also why we've had a great track record here in Indiana. This is kind of a hard one. When you talk about property appreciation, so you have to look for a property that has what I call good bones in it. It could be a 1970s built product, but if it's in an area that has maybe good highway access, it's got good employment around it. You have to say, well, what's the ability to still appreciate that property, a 50-year-old property? Well, properties can still appreciate if you do the right type of rehab. And I think we have that down. For an example, we're rehabbing a property up in Lafayette, Indiana, right off of 65, which is the main drag between Indianapolis and Chicago. And we're doing, I think, about $3 or $4 million of rehab work on the property. And it's looking gorgeous. We're installing washer and dryer hookups in every unit. I shouldn't say every unit, 90% of the units. And our tenants are paying for some of those amenities as they come into play. We did the workout facility. We put, barbecue areas. We put pergolas in. We just made the property more accommodating for tenants. We redid all the patios. We're repainting all the properties, and we're doing a massive amount of interior works in the hallways, with LED lighting, better doorways, better carpeting, and just again making the place a better place for our tenants to live, which is, for our company, it's very important of us to take care of our tenants, take care of our employees, take care of our tenants, kind of everything else falls in line. I got something I heard kind of applies what I said before as far as diverse employment base, but high percentage of low risk industries, white collar, blue collar, whether it's a small manufacturing, large manufacturing, whether it's distribution centers that are recently moved in, those are all things looked for in an investment that you're considering. I put high rated schools in there. That's kind of mixed a little bit. If you're in an apartment, sometimes it's in more of a commercial area. And a lot of times apartments are not necessarily for families. But if you're looking for that, then you have to pay more attention to where that property is located at. I wanted to show this because this is probably our biggest success story that happened last year or earlier this year. It was, we bought a property called Parkview, changed the name of it. It was really originally called Astoria, but we changed the name of it to Parkview. And it was bad. It had, as you can see on the lower left of that picture, I'm not going to go through the verbiage, but you can always download this from our website at jamesmgt.com under investor service, under investors. And you can kind of take a look at it a little bit bigger because that print probably pretty fine on the screen. But if that lower right on the picture, it shows, it's probably hard to see on the video, but that's mold inside of a property. We acquired this property when it was, I think it had 16% occupancy. And it had dozens and dozens and dozens of, down units, down buildings, a big rehab, had not been taken care of for a long time, but it was in a good area. It was in an area that was in demand for workforce housing. And we saw the potential there. It was a huge property. So we went through and did major modification and renovations to both the buildings, the interiors, and also the exterior. Pretty much all new pavement, all new sidewalks, new doors on a lot of the buildings, new siding, new roofs, a lot of new windows. Inside we do new cabinetry, laminate floors, Nice playground. The place looks great. We took an offer on it in almost like 2.5 years after we acquired the property, and we're able to sell it at a good profit. So we acquired the property at 5.3 million, and we sold it for 23 million. So that's typically a pretty good return. So I'm sorry, 28 million. So it's usually a good number to when you can get that. You can't always count on that, but it was a large property, 386 units. And it was an unsolicited offer, but they gave me a price that we couldn't refuse. So that worked out really well. Anyway, let's just review this. The reason I put this up here is that, again, when you're looking at a sponsor, make sure they know what they're doing. We did, I think the rehab work on this property was about 6 million. So we worked with an external third party, a construction company, to do a lot of the heavy lifting, some of the roofs, some of the asphalts, windows, and we have our own crews that do some of the units themselves. So it's kind of a mix of both, but due to the size and magnitude of the property, that we had to kind of go through all that. Another case study, Peachtree, still own this property. Same typical type of things. It was just in, the owner had not taken care of it. He had the property, if I remember right, for 10, 15 years. And just really didn't put a lot of money into it, and it needed a lot of work. We had to replace, I think, most of the fuse boxes. A lot of the plumbing needed to be updated. Sewers had to be updated a little bit. The exterior wasn't too bad, but just needed some cleaning up. So you can kind of see from the before and after. We did this on top and bottom, so apologize for that. But new sidewalks, new painting. We took one of the units, and that was an office, and used the old pool house and basically updated it and made that the office. So we increased, rent at the property by a fairly good amount, because property only has like 77 units. When we took it over, it had 76. We added a unit to it, which adds a tremendous amount of value to that property over the years. So it's typically something really good to look for. But again, those are things that you look for in a sponsor to make sure they know what they're doing. Rethinking your investment strategy. I kind of like this. It talks about, what you're trying to accomplish. Are you diversified? People have probably heard this forever, but one of the things, and I know this for a fact, that a lot of people that have, especially cash in like an IRA, have a tendency to be, sometimes when they direct it themselves, sometimes they can be a little bit more risky. I would probably question anybody that's on this is, how many people have taken some of their IRA money and invested in cryptocurrency, and I would say a fair amount of people have probably done that. So, myself included, and it's really good. I took $10,000 and turned it into $2,500. So it was a really good investment. Just kidding. But 20% rule is always I don't want you should never have all your money in real estate, for example. You should have it in stocks and bonds and different types of technologies. And some of it should be in real estate. It gives you kind of the best of both worlds. And we do the same thing with our investors. I have a lot of investors that may deploy, 500,000 with me, but they'll deploy it over several properties, not just one property. So they want some diversification within my own portfolio. The other thing that we do as a company is we think it's steady income. We do, once a property is stabilized, and again, it depends on what I'm doing. If it's a brand new property, I'm just trying to get it leased up, or if it's a property that I buy that I'm not doing much work with, or if it's a property I buy that needs a massive amount of rehab work. It depends on when stabilization occurs, but we try to get it stabilized as fast as possible, usually within 6 months. And we try to give our investors basically insight to what we're doing on a regular basis. So one of the things that my colleague that sits across the wall from me, we do what we call quarterly distributions, and we do quarterly updates. So we basically tell you how that property is performing to your expectations, not mine, your expectations. So, and that's always important to make sure that you're aligned with your sponsor from an investor standpoint. The tax benefits, well, I can back up on that a little bit. when you invest with some companies, from a sponsor standpoint, you can invest in a fund or you can invest directly in a property. If you're invested directly in a property, you typically have direct ownership of the property, and it can be a little bit better from a tax standpoint. But again, I always caution everybody to make sure you discuss that with your tax consultant to make sure you're investing in the right areas for the right reason, and it's the tax advantages are what you think it's going to be. And then because it is a physical asset, so it's not like buying a fund and you have no idea where the money's at. You're actually buying 8% of ownership of a apartment building. So, some of this stuff we kind of mentioned a little bit, but again, I can't emphasize this enough. Is what do you look for in a multifamily investment firm? And some of the things that you want to, make sure of, and these are just questions, you can copy all these questions down because it's not going to change. What's their expertise? How many deals have they done? Do they have a good track record? The property that they are raising funds for, is that their expertise, or is this something brand new for them? So they don't have expertise there, but yet they're claiming they're going to make you a 20% IRR return on it. Have they identified the market right? They should be able to provide you with information that says, this is why we selected this particular asset in this particular location. Are they the property manager, or do they outsource that to a third party? And I think that one of these comments on here is probably incredibly important, is sponsor equity. I can't tell you that we do a certain percentage, but we have typically 10 to 20%, sometimes more, in every property that we own and every property that we acquire. So we are direct ownerships. Some of those investments are from the general partner standpoint, but some of those are through other avenues, like myself. I'm invested in properties within our portfolio, about 6 or 7 of them, but that's directly into that property. I have no special treatment. I'm treated just like any other investor. But I found it's a good avenue, and I think there's most people at the company, especially on the management side of it, are invested in the properties with their own personal funds. And just so you know, I'm also invested through an IRA fund into our own properties. So one other thing I want to say there is that when you look at a sponsor and you talk about how long they've been in business, repeat investors is probably key. One of the things that we pride ourselves on is a lot of investors have been with us since we started investing in Indiana in 2005. They're still with us today. We kind of pride ourselves on that, that we continue to have a strong investor base. So it makes it, I think it's good when you can provide your investors with decent returns. And, when you call us, we typically pick up the phone and talk to you. So you don't get voicemail. It's not an email. It's not inquire@jamesmanagement.com. It's, the number on some of the bottom of the screens here is my phone number. So if you ever have a question, you can call me directly. So before I get too far down this, I wanted to point one thing out. I kind of went by this. I'm going to go back to Beech Tree real quick. When you look at one of the things that we do what we call is a pro forma. A pro forma is basically how are we looking at a property that we're acquiring, and what do we think we need to do to that property to maximize rents and grow the value of the property. So when we look at Beech Tree, we say, okay, we've got to invest X amount of dollars. Can we raise rents X dollars in that marketplace? And what does that marketplace can absorb? So if you look at this particular property, it's 6 miles or so, 5 miles from downtown Indianapolis, just on the south side, inside the Beltway. Fantastic location. It is done incredibly well. We just did a refinance on it earlier this year and locked it in at a pretty good rate, but we put it on long-term financing. And when I did that, it returned, a fair amount of capital back. And investors typically like that because now they're still invested in the property, but it's they have less equity in it and they can make their money work a little bit better. So that works out, and most people like that. We did that on Colonial. I said Beach Street. We did it on another property called Colonial, not Beach Street. Beach Street, when we refinanced it, we returned some money, but basically the property is now funded for the next 10 years. And it's already cash flowing well for our investors. So I don't have a lot on here. This is, I think part of it is just to make sure everybody's aware of what your investment strategies can be and different asset classes that you can invest in. And it behooves you to look at different ones. This is not a sexy investment. This is not, something that you're going to make, 10 times your money in 3 months. This is something that has always performed better than the market has, even in the last few years it has. Because the thing that this does is that typically your returns, and again, consult your tax advisor, most returns are typically don't pay taxes on it because you get depreciation losses against everything. And it sits there. When we sell a property, we allow our investors to 1031 their funds into something else, so they don't have to pay capital gains on that windfall that they just had. When you're in a fund, you don't get those options. So we return capital, we give you good distributions, and we can also roll your profits and funds into that next investment. And that just requires a timing on our part, which we've been pretty good about doing. So I'm going to stop for right now and see any questions that you have. And I think one of the things that Will mentioned is if you can put that in the question and answer section, we can answer some questions that folks have. So I've got one question so far, and one of them is, why invest with JMG? So I think we were just awarded one of the top companies to work for in Indiana, and we kind of take pride in that. In fact, I'd show you my T-shirt that we got from that. So, but it's something that we think is really good, and we're kind of happy about. But again, it's just, like I said before, it's not something that's terribly sexy. It just pays good money. We're a small company. We have 25 properties, 2,500 or so units. And we try to buy units between 100 and 300 units, but because the market's so high right now, we've been buying smaller units, 20 units, 30 units, but we've been buying them where we already have basically a good base of employees and properties that we can absorb, maintenance workers from different areas and stuff like that. So we find that to be a more profitable strategy. And the other thing that we have one product that we're have on the market right now. So if you see on the screen, your little QR code, you can always click on that. It tells you a little bit about myself, about the company. And if you wanted to look at anything that we have on the market, including some of the case studies, you can go to the jamesmanagement.com/investor services and get a little bit more information. But as far as how to invest, it's probably a conversation we could have separately. So for those of you that are interested in a specific investment, not necessarily today, but maybe in the future, please feel free to reach out to myself or reach out to Will directly, and Will can kind of put you in contact with me. And if you have any other questions. And the other thing is that the minimum investment is $50,000. So a couple people have already asked that. And so it's fairly, we just typically draw the line there. So most of we have, I have to think about this for a second. I think we have about 60 to 80 million in equity invested through investors, and we have about $200 million in asset value today. So, and most of the property we've owned for since We refinanced some here last year, and we have probably 6 or 7 properties we're looking at acquire, but they're not tied in yet. So we kind of have to do our due diligence first before we can offer them or offer them up to investors. If there's any other questions or somebody wants to chime in here, we have several more minutes to list to before this expires. I did want to bring up one other thing is when you talk about from an IRA standpoint, just to kind of be clear, is when we do a distribution, the distributed funds are put directly back into your IRA account. So you'll show that you've invested, for example, $50,000, and we do, let's say our investments are usually 6 to 10% cash on cash returns. And then you typically get an equity hit at the end. We always strive for, double money. So that's always my goal. Double money means with distributions and the sale of the property, you've doubled your investment. So, and most of our investments are 4 to 7 years. And I kind of say that as a broad space because I just don't know what the market's going to hold. The last thing I want to do is be forced to return, cap or sell a property before it's time. I think I'll give an example real quick since it popped up. On a $100,000 investment, let's just say it's a 7% return. So 7% return, and I want to tell you about our fees real quick. So we do a 90-10 split. So we take 10%, and we have no other. It's basically their structure. So you'll get, if I do a 7% return on a $4 million investment, that's $280,000 on an annualized basis. Take 10% off the top of that, and the rest is distributed to investors. So whatever your percent of ownership is of that, then you would get that balance divided by 4 quarters. So it's 1.7% or 1.6%, on a quarterly basis. Hopefully that answers a couple questions. One thing that we also do is we do K1s. So if you're not familiar with investing in real estate, one of the things that a lot of people ask for is, what kind of documentation do we do? So we'll give you a K1 that'll show you, you basically, here's your gains, here's your losses based on the property with depreciation. So you basically hand that to your tax advisor, and he'll make the determination of how that applies. It's typically pretty good from that standpoint. So from a write-off standpoint, because it's usually a negative number. But again, consult your tax guy. They'll be more familiar with how it applies to you specifically. Any other questions? Beth, do you have any other questions for me?
No.
Yeah. Did I miss anything?
No.
She's being too polite. Anyway, I don't, Will, if you're still on, I told you I wouldn't take a full hour. So, but just give me a buzz. Let me know how I can follow up with anybody. My contact information is on the screen, and I will have everybody have a great day.
Thank you, Jerry.
Thanks, Will. Thanks for setting this up. I appreciate it.
Absolutely.
All right. I'm just going to end this now. Okay.
Yes, sir.